Now we get to the stop hunt technical setup, and we're going to be looking at how iceberg orders, liquidity and slippage, and the zero sum game, is really applied to some price charts. And I'm going to be going over some screen draw examples and getting into some charts as well. So before we do, we must keep in mind that the financial institutions in their mindset and how they have to transact, so they need to find lots of liquidity, um, but low volatility, to avoid slippage. So there's often a an idea that basically says, and people tend to say, that retail traders shouldn't really matter. Why would they go for our little stop if we only make up 7-8% of the market? And 7 to 8% of the forex market is of 4 trillion is actually around 300 billion, dollars of daily volume. So the banks, your stop losses, right? When you lose, they pretty much have 300 billion to kind of look for, or around that in the markets. So that's money that they can take, and we know that 90% of traders, don't necessarily make any money in the forex market. So again, it goes back to the zero sum game. You lose and they win. Money is transferred to the winner from the loser. And as someone who needs to undertake, money, and an entity that needs to take money from their opponent, I need to understand what my opponent is doing, right? So there are 3 main trading disciplines, right? And some of you who obviously have traded the Capture Pain Relief course, you'll know about breakout traders, retracement, and level traders. But we'll go over it again anyway. So in order for me to understand my opponent and to look for their stops, I need to understand their strategies. And there are thousands of different strategies, but there are 3 main trading disciplines. And these are them: breakout, retracement, and level trading. So just to go over it quickly, you've got breakout traders who literally are looking at breakouts of levels. So the level might come up, price might come up to there, and then what they will do is they will look for some sort of bullish candle and look for a breakout or any kind of price action that convinces them that an obvious level has broken out. Retracement traders will be looking for a pullback. So same thing, right? They won't get in like breakout traders do. They'll be looking for a retracement, and they're looking for some sort of pin bar within that area or engulfing candle, any kind of bullish price action before they look for long trades. And level traders just pretty much trade levels. So they will literally trade, if that's an obvious level, they will trade it to the downside. And if that doesn't work out, then they will just trade it to the upside. And if that doesn't work out, then they will just trade it to the downside, etc. Yeah, they just look for levels to trade off of. So why is that important? Because by understanding the trading disciplines, you can understand where their stop losses are placed. So again, from the breakout trader, right? Level breakout trader gets long here. Let's say they're going to be placing their stop losses where? Here or behind a swing. With retail traders, retracement traders, they're going to place their stop losses where? Either below the level or below the swing. And again, level traders will be looking at, they're trading there, their stop loss is going to be there. If they're trading here to the upside, their stop loss is going to be there. Again, there's only a certain amount of areas around areas of support and resistance where you can really place your stop losses. So that's where the money is, right, for the financial institutions. They know exactly where your stop losses are. Now, what's also important for the financial institutions is the market state, and there are really only two, main market states. One is a ranging market, yeah, almost known as the accumulation phase, and we have trending markets, sometimes known as a distribution phase, and then markets just go into ranging and then trending and then ranging, etc. Yeah. So the market state that is, I guess, conducive to iceberg order accumulation is ranging markets. Yeah. So ranging market. And ranging markets will tend to be lower volatile than a trending market, right? Because pretty much most traders are trend traders. Breakout traders are expecting the anticipation of a trend, and retracement traders are looking for higher highs, higher lows, or lower highs and lower lows. In a ranging market, retracement traders and breakout traders are markets are less volatile than they are in the in a trending market. So this gives financial institutions cover in order for them to accumulate their iceberg orders. So again, if they've got, let's say, 100 million that they want to break down into smaller orders, what they can do, and they have to do what? They have to buy in the face of selling. So whenever there are pullbacks within a ranging market and the market is, going down or even going up, but mainly going down, is they need to be able to buy here. So you can do 5 million there. They can do another maybe 10 million here, maybe 15 at the bottom, and so on and so forth. Yeah. This is where they can accumulate without the high volatility, and they can disguise their iceberg orders until they get filled. Right. This is the reason why it's known as the accumulation phase. Yeah, because these are again the market state that is preferred by the institutions are the ranging market. So this is how the financial institutions will take advantage and stop hunt breakout traders, retracement traders, and level traders. And remember, they are searching for liquidity. So what we will have is some sort of ranging market at some point that creates levels, obvious levels like so. And what we want to see is a clear and obvious level, either to the upside or the downside. And why is this important? Because in a ranging market, the first real traders to put their stop losses somewhere and enter into a trade is going to be what? Level traders. Yeah, level traders are looking at levels here, an obvious support, in order to get involved in a trade. So they've seen the price action work here, for example, and prices have gone to the upside, and they may have seen it work somewhere around here. So what you want to see is at least two touches of a level and obvious, clear and obvious support. Now what will happen is that these level traders, if prices come back down to a level, will do what? They will want to buy. And if they buy, then their stop loss orders are placed below this area here. So we want to see some price action that convinces level traders to get involved. So pin bars, engulfings, any kind of bullish price action that convinces traders to get long here, because their traders are generally not going to enter into a trade. There are some traders that will trade levels as far as limit orders and things like that, but generally most traders will look for price action in order to confirm their belief that the level will continue to go higher and place their stop losses below. So again, I know where they're placed, so the financial institutions know the place is the only logical place where the stop losses can be placed. So once that occurs, we get a stop hunt. We get a move that will trigger these guys' stop losses, because what's been happening in this accumulation phase is the financial institutions have been buying in the face of selling, right? 10 million here, etc. 10 million there, right? Now, remember as well that we're actually on a price chart. So while they're accumulating, the best place to accumulate and buy more is where? Is for cheap. Yeah, so they're buying at this price point, whether this is 2 or 4, whatever it is, and that being higher and higher. What better place to buy if there's a load of orders and sell orders here? So they need sell orders in the face of buying. They need to search for those stop losses, those sell orders, so that they can fill their iceberg orders. So also what happens at the same time as filling their iceberg orders and being able to buy, they're also triggering stop losses, right? So again, the zero-sum game, money is going from changing hands as they trigger the stop loss. So let's say, for example, there is, let's say, for example, there was $30 million worth of stop loss orders below the market, because you've got loads of traders looking at this level here. If it only costs them, let's say, for example, 5 million to drive prices down, they can obviously make a bit of a profit by driving prices down, as they are the ones that move price and trigger stop losses, as well as they're able to buy at this area as well and buy for cheaper. Yeah, they can buy for cheaper. And also at the same time as they're triggering stop losses, guess who is getting involved here as well? What kind of trader is getting involved? You've got the breakout trader. And the breakout trader is doing what? They are pressing short. They're pressing sell in order to go short at the market. Yeah, at that level. So they want to see some convincing price action, bearish price action, that convinces them in order to enter. In the same way that you would want to see convincing price action in order to go long. Breakout traders who have been frustrated at the fact that this has been a ranging market and are looking for some sort of trending market, as the market goes from ranging to trending. They are also doing what? Selling. So again, the financial institutions can buy in the face of selling. So that's more orders that are being drawn, sell orders that are being drawn into the market, more liquidity for the financial institutions to be able to buy. And then the next phase of this is going to be retracement traders who get involved on a pullback. And once they start to get short as well, again, financial institutions can buy, because you've got a level of support. Support should turn to what? Resistance right here. So once the the financial institutions have, filled their order, whether that is, 100 million, 100 billion. We have no idea what that figure actually is, day to day, and how long it's going to take. But whatever that order is, and they've got enough, and they understand they've manipulated the market in order to fill their iceberg order, IBO, then they don't have to hide their true intentions when they actually now want to buy. And they want to tell the market and signal to the market that I filled my iceberg orders, now I've got nothing to hide, and I'm going to start buying at this price point here. I'm going to start buying and letting everyone know that I'm going to be buying. They don't need to hide anymore. And what do you think that does? That draws prices, that pushes prices to the upside. And what this also does is these retracement traders and level traders that get involved, because level traders will be getting involved here, not just retracement traders. Also, they've got their stop losses placed where? Around here too. So their stop losses are placed right above the market. And again, as the financial institutions push prices to where they want prices to go, where is the money being transferred to? If they lose, then the entity on the other side of the trade wins. So again, it's the zero-sum game, all in effect around this area here, taking advantage of the breakout trader, the retracement trader, and the level trader, right? While they can buy for cheap, disguise their orders within a low volatility type market, and buy for an absolute bargain price, because they know where the stop losses are, they know where the orders are, and they are searching for that 300 potential billion. Not to say that there's going to be 300 billion down here, but they're searching for the liquidity of retail traders, the sell orders that are going to be generated, because as well you have to also think about how many traders would be buying in this area. How many traders are buying here from a technical analysis perspective? There's not many strategies out there that are going to tell you when prices break a level, you want to be a buyer. They're all telling you to do what? Get short. And even the brokers and their technical analysis courses, they tell you support becomes what? Resistance. Resistance becomes what? Support. So they're telling you what they want you to do. And this is what stop losses and sort of stop hunts, this is how the financial institutions manage to stop hunt traders before going, on their merry way. And let's look at the stop hunt setup from a buying or a selling perspective, I should say. All right, so we've got a level here. What you want to see is a level that's been touched and it's obvious and clear, to anybody. That could be there, etc. Minimum of 2 touches. All right, or where you see a ranging market. Right, this is what you want to see. So again, when prices come up to a level, you see convincing price action to the downside. You want to see that type of price action at the level, and that convinces traders to place their stop losses above here. Level traders who are looking at levels, touch, and it's touched several times and it's always worked. So this time should be the time that it's going to work again. Again, where the stop loss is placed. They're placed in and around there. Then you have price stop them out. prices will stop them out and look for the liquidity above the market, because if the market wants to get short, in this case they want to sell, yeah, they're looking for the opposite. So before they wanted to buy, so they had to buy down here, whereas now they want to get short, or they want to dump, or they want to buy the quote current currency rather than the base currency. Then the stop hunt has to occur at a level where it's advantageous for them. So they're looking for stop losses above the market. Right, so first of all, they take out the level traders stop loss. They seduce the breakout traders to get in. And then they want to also seduce the retracement traders to get in. And that's the pattern. That is basically what we're looking for when we are looking for a stop hunt on a price chart. Understand that there's going to be a lot of traders being stopped out. Liquidity is all above the market, is all above here. Remember, the overall direction for the financial institutions is to do what? Is to get short for whatever reason. Yeah. But when you see a level that's been touched once, twice, at a minimum 3 times, and then you start to see price action that looks like it's working. So again, you want to see convincing price action like pin bars. You want to see engulfing candles, price action that starts to look like it's selling off, and understand that these traders are going to be placing their stop losses in the only place that they can, which is to the short side. The financial institutions are accumulating. Yeah, so they're looking to sell in these areas here. They can disguise their iceberg orders. Yeah. And then they manage to manipulate the market before driving prices ultimately lower.